This is ESG Decoded, the podcast powered by Global Affairs Associates to provide relevant, actionable updates related to business innovation and sustainability. Join Kaitlyn Allen and Amanda Shea of Global Affairs Associates for thoughtful, nuanced conversations with industry leaders that explore the complexities, the risks, and the opportunities connected to all things ESG. I'm Yvonne Harris, a consultant and co-host, and I will be collaborating with Kaitlyn and Amanda for the discussions that we will present on this podcast. Put simply, ESG is everything that is not on your balance sheet. This leaves room for misunderstanding, oversimplification, and the tendency towards one-size-fits-all perspectives. None of that will happen on this podcast. Enjoy this episode.
Welcome back to ESG Decoded. This is Kaitlyn Allen, and today I'm with Jeff Dangremond. Jeff guides companies, individuals, and financial institutions to set their strategic and tactical financial direction while incorporating ESG goals and initiatives. Jeff has over 30 years of experience and a successful history of working in the financial services industry, with a specialization in fiduciary wealth management, commercial lending, and portfolio oversight. Most recently, he led the development of ESG-based lending products and initiated an ESG-focused investment platform for a US-based financial institution. Jeff also recently joined Global Affairs Associates as a senior expert. Jeff, welcome to the podcast.
Thank you. Very happy to be here today.
And this is a topic that is just so fascinating, but doesn't often make the headlines. Today, we're going to talk about the role of banks in solving global challenges like climate change. We, of course, talk a lot about the environment on this podcast because we are in the energy capital of the world in Houston, but that can be beyond energy as well to other global challenges like inequality, water, etc. So it's very broad, and we all know that banks play a large role in our lives and our society, even if they're not always at the forefront of the headlines. So this is a really important topic, and we're excited to hear your perspective, Jeff.
Yeah, well, it won't come as any surprise to anyone that with the background that I have, I tend to see the world based on risk. And banks, by and large, are focused on two things. And the first is obviously profitability, and the second is reputational risk. And over the course of the last 3, 5, 7 years, you've seen more and more that banks have become concerned about reputational risk, a lot of it associated with the clients that they're lending money to. And so certainly there are many different types of risk, economic risk, inflation risk, credit risk, et cetera. But banks have become so focused on the reputational risk that exists that can really come back to hurt them if they're not paying attention to it. So I think that banks, as well as private equity groups, really play a really large role in pushing forward ideas related to sustainability and ESG. And again, from my point of view, I think it all is associated with a function of analyzing risk. So it takes the emotion out of it, and it takes something of the political slant out of it, and it looks at it just based on, by not knowing certain things, am I opening myself up to a greater level of risk? And I think banks are starting to ask themselves that question and need to ask themselves that question, especially if they want to maintain an ongoing concern status and certainly maintain a level of competitiveness.
Let me ask you, we know banks it's not a monolith, right? We have commercial banks, we have central banks like the Federal Reserve, National Association banks. How do each of these groups, broadly speaking, approach issues like climate change, or do they?
I think they do. And I think really broadly, central banks like the Federal Reserve, like the ECB, European Central Bank, and others specifically set rules and regulations associated with banking in whatever jurisdiction they cover. So we hear about the Fed a lot. You also in the United States have the Comptroller of Currency, the FDIC. The FDIC, you're probably familiar with, insures your deposits at a financial institution. So they're the agencies and the oversight to the banking world within the United States. Central banks exist all over the world, but the Fed is the oversight for banking in the United States. And so national association banks are primarily every bank that you see out there. And that would include, the Bank of Americas, the Citibanks, the Wells Fargos, National Bank, Bank of the West, as well as most of the medium to small community banks that exist. There are private banks that do exist, but they're few and far between. So I think for the most part, we're probably talking about national association banks. You'll see it sometimes in the actual title of a bank. It'll say Bank of America N.A. And a lot of people think, oh, that must mean not applicable. But that's not what that means. It means national association. So that's a little bit of a fun fact. So to your question, a gap that exists among central banks in other parts of the world and the central bank and oversight in the United States. And to that end, the ECB, the European Central Bank, has dictated policies and rules and regulations associated with financial institutions in Europe that very specifically require them to provide greater level of transparency and an analysis of their portfolios to determine what level of sustainability, if you will, exists within their portfolio. The United States, by and large, is far behind that. What you're seeing right now are a lot of open commentary periods for individuals, trade associations, companies, banks, interested stakeholders to make comments to the SEC as well as other agencies to determine just exactly what the specific oversight is going to be toward the National Association banks. But there are also credit unions that have a level of oversight. There are private equity groups that are motivated completely differently than financial institutions. There are commercial finance companies. Commercial finance companies don't take deposits, but they make commercial loans. And there's a different level of oversight too. Whether there's oversight or not, whether there's a top-down push for rules and regulations, it's important for all of these entities, the commercial banks, the commercial finance companies, the private equity groups, the credit unions, et cetera, to really focus on sustainability and ESG issues, again, because of the risk component. If they don't do that, then they may find that they're losing clients, they're losing opportunities, they're suffering from a reputational standpoint, et cetera.
It sounds to me, Jeff, that the risk component is really salient here. It makes me think about the TCFD. We know that Task Force on Climate-Related Financial Disclosures was itself initiated by the central bank governors and finance ministers of the G20 countries. So it's interesting that a lot of that work on the risk and the, say, concern about risk is coming from the finance gods, so to speak, that really are in charge of the economy. They're in charge of making sure funds are worth something in 20, 30, 40 years. But that is not necessarily a monolith of the banking and finance sector. So there's really all these different players looking at it differently. And from your perspective, that risk lens is the sort of common thread.
Yeah, it definitely is. It is the old adage of follow the money. There's nothing that will motivate people more quickly or keep them focused than potential threat to the acquisition of capital. So if for any reason a company, because they didn't provide information, wasn't going to be able to access debt or equity, you can be sure that very quickly they're going to provide that. If a financial institution is suddenly seeing a diminishment of their value based on their stock price because people don't want to own their particular shares because they're not paying attention to risks associated with sustainability, then very quickly they're going to change the ways they do business. So yeah, you're right. I think money motivates.
Jeff, you've educated me on the Basel Accords. I wanted to ask you, what are they? How do you see them influencing the conversation related to sustainability and banking more broadly?
Yes. So the Basel Accords were recommendations that were made by the Basel Committee on Banking Supervision that's based in Basel, Switzerland, thus the name Basel Accords. And they were adopted. There was actually Basel I, Basel II, and Basel III that were adopted in the early part of this century over a period of time. And they were adopted by banks worldwide because what they did was they basically set certain standards that banks globally had to abide by. So they set minimum regulatory capital requirements, they set supervisory review processes, they set certain disclosure requirements that had to take place within particular markets. And what's interesting is that the Basel Committee on Banking Supervision has just recently come out with a couple of recommended standards. Now, the Basel Committee itself doesn't have the authority to dictate that these things be put in place, but as was the case in the past, when standards are set or recommended internationally, they tend to be adopted by all countries because people do business globally. And so you set those standards. The Basel Committee has published 2 reports that discuss climate-related risks to the banking system and measurement methodologies of those climate-related financial risks. I believe that based on the fact that the Basel Accords 1, 2, and 3 were put into place and picked up as they were worldwide, including in the United States, that you can probably make a pretty good bet by saying a lot of the recommendations that are being made by the Basel Committee are going to be picked up, certainly in the European Union. In many cases, they already have been, but probably also in the United States. It's one of those situations where, in order to do business in the European Union, you're going to have to abide by those rules and regulations. And if you don't, you're going to be at a huge disadvantage in terms of business activity.
I think that's so interesting because that's, a lot of people don't follow what's happening on the global stage. I think to their detriment. That's really one of the reasons I named my company Global Affairs Associates, really helping to interpret the happenings on the international stage and how those really do influence global economies and influence capital markets. Those 2 reports, we can include links to those in the podcast description. And I wanted to ask you about another group that seems to be quite influential, but I'm just curious as sort of an industry insider, what you think. And I'm referring to the Network for Greening the Financial System. We've seen a lot of, big splashy announcements. So I was just curious, what do you think about the Network for Greening the Financial System?
I think that like many of the groups that are being noticed, whether they're the frameworks and standards groups, such as TCFD or SASB or GRI, that you do have a group like the Network for Greening the Financial System that, is a group of central banks and financial supervisors that are looking to scale green financing and develop recommendations for central banks' role for climate change. So they're looking at a 30,000 foot level, what things can we put in place? And they're trying to influence the behavior of central banks to thus influence the behavior of the banks that are associated or overseen by those central banks, if that makes sense. And I believe the Network for Greening the Financial System is based in Europe, in Paris, I believe. And, to a comment that you made just a little while ago, a lot of times I think there's a tendency for us to think about the other. Oh, that's happening somewhere else. Or, oh, this group is in, Paris or Basel, Switzerland, or somewhere else, not here. And what could this possibly mean for me? But what I'm here to tell you is that these ideas and these concepts are really being put into place in places like Europe with the EU taxonomy and some of the things that the ECB is doing and the influence that the Network for Greening the Financial System is having. And those things will come across the ocean to the United States. Now, that's not at all to say that somebody in Paris is dictating the behavior of a bank in Arizona or Massachusetts or Texas or anywhere else. It's just to say that the ideas that are associated with the risk components that are of concern to the central banks and thus the banks that make up the industry within a particular company or country are really going to need to have a defined focus. So influencers like the NGFS, as well as others, play an important role in setting those standards or pushing those ideas or influencing. A lot of these groups don't have necessarily authority to penalize people if they don't put these things in place, but what they can do is they can influence central banks to adopt these rules and do so consistently. I think probably what you're going to see is a lot of consistency between NGFS and the Basel Committee's recommendations for climate disclosure. All these things are coming together. And I think one of the issues that exists too in the United States is the fact that there hasn't been a big focus on this. The previous administration, political administration, didn't focus on it at all. The new administration is, and I think for good reason. Again, taking it out of the political realm and more into the risk realm. If these things are not focused on, then it puts at risk the ability for companies and financial institutions to access the capital they need to continue to grow and do the business that they're built to do.
And I just want to add too that you look at the membership of the Network for Greening the Financial System, it's absolutely not European countries only. It's right. India, New Zealand, People's Bank of China, Russia, you can look at it online, right? Egypt, Japan, lots of Latin American countries, Dubai. So it's certainly, it's 83 central banks. So that's a pretty good share of the world's central banks and finance ministers. So very, very interesting. Let's take it down to a more local level. I'm wondering about sort of the National Association banks. Let's take an example of, say, a smaller Texas bank, or you're in Arizona, a smaller Arizona bank. What should they be thinking about?
I think that right now, within the United States, one of the countries you didn't necessarily mention for the Network for Greening the Financial System was the United States. And so there are a lot of different countries and central banks that are cooperating and pulling in the same direction. But, as tends to happen, the United States stands somewhat apart from that. And again, it's not to say that the US doesn't have an interest in this, or at least some level of participation. However, to the extent that there are not necessarily standards being dictated to commercial banks, National Association banks in the United States, there's a tendency for financial institutions to say, well, I'm just going to wait until somebody tells me what to do. And I think that you do that at your own peril. I think, to take an example of a bank in Texas, a small to medium-sized bank in Texas or Arizona or anywhere else really in the US, that you need to be looking at what are the things that are impacting the clients that you have that make up the portfolio of loans and the clients that you lend to. What are the types of things that they need to be concerned with? And you're hearing a lot about greenhouse gas emissions. You're hearing a lot about water usage. You're hearing a lot about supply chain management. You're certainly hearing a lot about social issues that exist, what level of diversity and inclusion exists at particular companies. Banks need to be concerned with this because, again, going back to my initial comment, lending to a company that's doing bad things in the community is ultimately going to reflect badly on the financial institution that is making those loans. And fair or not, it is a certain reality. You'll remember the case of the Dakota Access Pipeline a few years ago. Wells Fargo was one of 75 plus lenders that were lending for the benefit of that construction of that pipeline. They were, for some reason, identified as the primary lender, even though you could have picked any bank, large size bank, and they were involved in that. What activists have come to find out is that to stand out in the field and protest against the company that's building the pipeline is very difficult, doesn't get a lot of press necessarily, and bad things happen. But if you stand outside of a Wells Fargo with a sign that says, Wells Fargo is lending to the Dakota Access Pipeline and polluting our drinking water and hurting our indigenous lands, that gets a lot of press. And so activists have become very smart in terms of knowing how to find what lending institution is actively involved or lending to a particular company. And it doesn't matter if it's in Tyler, Texas, or Chicago, Illinois. It doesn't matter the size of the city or the size of the bank. If bad things are going on, it's going to be exposed that that financial institution is involved. And going back to the thought of reputational risk, they want to try to avoid that as much as they can. And so I think what this means for a small bank in Arizona or Texas is that they need to be aware of issues that potentially exist for their clients, and they need to know those things. And this is where I think banks can play such a huge role in pushing these ideas forward. Look, if you're never asked, hey, do you happen to know what your total water usage is for the previous year? You might not think it's important, but if a bank is asking that question, you as the client, you as the borrower is saying, this must be important because the bank is asking for it. And it's important that I provide this information, because to not provide this information potentially could put at risk my ability to access the capital I need to run my business. Conversely, on the other side of that, you have the ability as a company to say, yeah, I'm going to collect this information and I'm going to provide this information, but I'm going to go to my bank and I'm going to say, look, I'm doing a lot to track things like my waste management, like my water usage, like my supply chain management, my greenhouse gas emissions. I want you to look at this relationship differently. I want to ask you the question, how many other companies that you have that are in your portfolio are doing the same things that I'm doing? And what that company is saying is those activities differentiate that particular company from its competitors. And that gives them leverage over the financial institution, because it now makes them a very prime target for other financial institutions who want to do business with a company who's doing those types of things. Because once again, having that type of loan with those type of metrics in your portfolio is much better than either having somebody that doesn't do those things or somebody who just doesn't want to know those things.
I think it's very interesting turning it around and saying that gives you additional leverage as a company.
Yes.
I think that's fascinating. We are hearing about friction in the market, particularly in Texas in the energy industry, with some lenders, it seems, doing almost a total exclusion of oil and gas lending, even if that company is aligning with the Paris Agreement. So first of all, is this really happening, and to what extent? And then what would you recommend the approach be to greening, say, transitioning companies that do demonstrate tangible targets and improvements?
Yeah, I think this is a case of, 1,000 shades of gray as opposed to just black and white. I think it's a mistake to necessarily exclude a particular industry, from the potential of being able to access capital via a loan. And so specifically within the oil and gas industry, I think since 2015, banks in the United States have provided close to $3.8 trillion in financing. And that's since 2015 with the Paris Climate Agreement. So that's still a large amount of money that's being invested or lent to that particular industry. But I do believe that it's a mistake to just say, we're going to throw the baby out with the bathwater. We're not going to lend any dollars to anybody that's associated with oil and gas. In a state like Texas, and as well as many others, that's very significant. You can't just, suddenly pull the plug. And I think you make a mistake if you do that. I believe, once again, that companies can differentiate themselves by saying, we are paying attention to these things. We are paying attention to the environment, to social issues. We're putting in place governance in our company that has an oversight, a check and balance to make sure that we're doing the things that we're walking the talk, if you will. And yeah, so I see that there are large financial institutions, B of A, Citi, Wells, and others, who have said just, we're not lending any money to anybody that is associated with Arctic drilling. So they basically, put a red line through that and said, we're just not going to do that. However, I don't think that those institutions have necessarily stopped lending to the oil and gas industry. I just think they need to be very quickly and very cautiously focused on who are they lending to and what requirements is the bank setting up to ensure that those companies are adhering to certain standards that don't adversely impact either their employees, the community, or stakeholders that are involved with that company.
I think it's interesting because without, myself being, immersed in that side of the world, of the finance side and lending side, the way you have, my perception has almost been that some of that friction is lenders not understanding the problem either. And I don't know if that's a fair statement, but you're nodding yes. I think it's sort of like the cart before the horse in a way, and that I'm seeing a lot of the media acts like all this stuff is already a given and those decisions have been made, but really on the ground, lenders are still learning, what does ESG mean? Lenders are still learning, what does this mean for my portfolio? What questions should I be asking? And as we've expanded our business, just anecdotally, from serving not only corporate clients, but now also serving clients on the lending and capital market side, we're really seeing that in a real way, that there's still a lot of questions that aren't answered. And so I definitely agree with you that, obviously once in a while there's just a bad apple and you don't want to lend to them, right? But the nuance of understanding what's the difference between a company that is committed to the Paris Agreement, that has set goals and targets, that is quite tangibly working toward being a part of the solution to climate change and actively participating in the energy transition. That type of company profile versus, say a company that just say head in the sand, doesn't want to look at the risk or gets too emotional about it. Like you said, the political emotional scale, they can't handle it, whatever it is. Right. Maybe that's an approach, right? Is what are you doing to be a part of the solution? And how is that concrete? Like you said, how are you governing those risks? How are you governing your targets and the management of achieving those? To me, that's the more nuanced approach, because if we want to solve global challenges like climate change, we have to have we can't do it without the traditional companies coming along for the ride. It's not going to happen if you do not get oil and gas companies on board with this. And so I personally think that type of commitment needs to be rewarded and not punished simply for being part of a legacy industry.
And by the way, that, the whole idea of ESG, it was born from investors. They were looking at the risks associated with environmental, social, and governance initiatives for companies. And, so to the extent that a company doesn't do things, I agree that, and there will be an entire spectrum too of companies that on one end don't do anything and on the other end are very proactive in terms of efforts to really do and understand everything they can. I think there's a nice place in the middle. And I think that this is where banks can, again, really have an influence. But I would say one of the biggest problems that exists right now, and this is true whether it's Bank of America or National Bank of Tempe, Arizona, and that is you can have lofty ideas and ideals about reporting and what we're going to do to become aware of ESG initiatives related to our clients. But until you push that knowledge and education down to the lending officers, who are the ones that on a daily basis are, given goals, hey, you've got to go out and you've got to do this many loans, this year in order to get your bonus or whatever it might be, or, in order to keep the portfolio at its level or grow another 8% this year, or whatever the goals are. And unless you've educated that group of lenders, the people that are interacting directly with those companies, you can have all the great ideas you want at a high level, and it'll never happen, or it'll be very slow to happen. And so, this is where I think there can be, once again, a real advantage for a financial institution who says, we're going to make our lending staff aware of some of the issues that are taking place. This is all very fluid. These things, these ideas, these regulations and policies are changing on a daily basis. There are a lot of different metrics and measurements that exist right now. And if you were a company trying to decide which of those to use, it can be very, very confusing. You can get a great metric review and score from one group and a bad one from another. And it's just because of the perspective of those particular standards. So to try to figure out all of it or know all of it is impossible. But focusing on, once again, an idea of risk. How can we change our behaviors as an institution to ultimately change the ideas and behaviors of the companies that we lend to? Can we create products within our financial institution that, for instance, incents a company to build a LEED certified building as opposed to the cheapest building they can build? LEED certified buildings cost more, but what LEED certified buildings do is they attract a better level of client. And that client can go into that building and attract a better level of employee, because the employee will say, hey, my employer is, focused enough to be in a LEED certified building. The values of my employer align with my own values. If you have better employees and you have better companies that are occupying that nice building, then as a financial institution, you're going to get paid back. And that's a much better thing for everybody. So what can a financial institution do as far as its products to create an incentive for a builder, for instance, to build a LEED certified building instead of just your run-of-the-mill building? Whether it's a discount on rate or fees, or something that along the lines of more favorable terms, perhaps that's a possibility. But once again, if you do that as a financial institution, you're separating yourself from other financial institutions that are out there. And potentially you're attracting a better clientele as well. You're saying, somebody else hears about it and says, hey, I want to build LEED certified buildings too. That's the place to go, because they're doing LEED certified loans and they're offering better terms associated with that. And, I can sell this building for more or lease it for more. I can attract better clientele. It's all related. So we talk about kind of the critical thinking aspect of this and how everything is connected. As you said earlier, it really is. You make a decision like that, you begin to see the ripple effects of that in that particular community. So it's interesting how that happens.
It's all connected, like you said.
Yep.
Before we jump to our final fun pop quiz for you, I wanted to ask about ESG-based lending products. So you have actually developed such products for major institutions. I wanted to ask about those. Can you give us some examples? Are you talking about sustainability-linked bonds? What is that lending product? Can you give us some examples?
In the particular case that you're referring to, I did not do sustainability-linked bonds, but those are out there, and those are really great sources of funding. However, what I worked on primarily were products that were associated with just line lending. So on the real estate side, I did develop a product that was associated with LEED certified lending, and that's on the commercial building side. So to the extent that we were doing commercial lending on real estate, we were able to offer terms and rates that were more beneficial. And once again, provided an incentive for that company to build that level and quality of building. On the mortgage side, we discussed lending to and creating lines of credit to ethical builders. So builders who built homes in a particular area, but who abided by ethical and sustainable models, reducing the waste. There's a tremendous amount of waste associated with the construction industry. And so what were they doing? How were they paying their people? What kind of benefits did they provide? Those sort of standards that were set, and that particular client and borrower had to provide to the financial institution to show that they were actually doing those things. Lines of credit associated with companies who said, we're going to reduce our carbon emissions or our water usage by X% between now and 2025. So if I set up a 3 or 5 year revolving line of credit to that particular company, every year they had to provide me with the information, verifiable information, that showed that they were actually hitting the targets that they were supposed to hit in order for them to maintain the lower rate that I gave them for doing so. So there are a lot of different types of products that can be created at a financial institution that do provide incentives for the clients, and I again think reflect very well on the financial institution, no matter what size. You could do this as a small community bank in a small city in a whatever state you decide, or you could do this as Bank of America. It doesn't matter. You can apply this the same way. In fact, Bank of America is doing it. So.
Well, Jeff, I think we could just spend an entire episode on every single topic that we've mentioned today, and we intend to do that. We will have you back on and go a little bit more in depth with some of these. But for now, let's wrap up today's episode with our fun question. I do know that you enjoy hiking, and I know you've done some pretty intense hikes as well. But what's the best hike you've done recently? Tell us about it.
Oh my goodness. The best hike that I've done recently, I had just an absolutely wonderful opportunity to go to Zion National Park and Bryce Canyon. And I was able to, as part of that, hike the Narrows, there's a river that runs between two very steep canyon walls. And you actually do your hiking in the river. So it's really interesting. You have on waders and you hike up the river, but it's so beautiful. That was the beautiful part of the hike. The other beautiful part, but the really, really hard part, was I did Angel's Landing. And I don't know if you know about Angel's Landing, but basically it's a pretty nice and challenging hike to a particular point up at the top where there are chains that are sunk into the rocks, and you basically hold on to those chains and pull yourself up to the very top, and you get just an unbelievable view of the valley below. The problem is that 2 feet on either side of that chain, and you're going to be taking the fast way down. It's a very popular hike, but it's not for the faint of heart. But it really was beautiful, and I don't mind heights myself, so I didn't necessarily have a problem with it. But there were some people that pretty much had a death grip on that chain on the way up and on the way down. But yeah, that was a lot of fun. That was a great hike.
Well, I admire you. That sounds incredibly challenging. I love hiking too. I'm not sure if I could do that one.
You can give it a try. I think, you'd probably like it.
I'll have to come out to Arizona and try it. Well, thank you so much. Again, we're just so excited that you've joined the Global Affairs Associates team, and we cannot wait to work with more financial institutions and sort of expand our capital markets practice. If you have any questions for Jeff, please contact us at globalaffairs.associates.com. And of course, follow us, like the podcast, subscribe, and all of that good stuff. Thank you so much, and see you next time.
Thank you for listening to ESG Decoded. Subscribe to this podcast wherever you consume yours, and follow ESG Decoded and Global Affairs Associates across social media platforms. Until our next episode, take what you learned today to drive long-term value for your organization by doing good for people and for the planet.